We are live on the show. Good morning, everyone.
Good
Good
morning,
morning.
Lisa.
Uh, Thank you for watching this morning. My name is Lisa Wickman, and it is the Biz Chat with Lisa. Today, this episode is actually brought to you by Perfect Virtual Assistants, where we help you buy your time back by bringing in back-end support of international talent into your business. And today, my guests are Rick Wenner and Jared Havens from Credilife. And we are talking today about buying power. So, welcome to
Awesome.
the show. First
Thank
of
you,
all,
Lisa.
Yeah,
Yeah,
thank you.
really happy to have you back on, Jared. We're going to be doing this once a month where we have these two gentlemen or one of them on to talk about credit and financial wellness and what that actually means. So, let's just dive in. One of you, why don't
absolutely.
you take it away? What is buying power?
Yeah, Rick, talk about it. I know you have these conversations every day with our clients.
We do. So it's no surprise that we're on with Lisa today because one of the biggest things that buying power means to most of our clients is putting themselves in a position to be pre-approved for a mortgage, to get a car loan, to start a business. So buying power is the ability to get the financing, secure the capital and financing you need to reach your goals, your financial goals.
Yeah.
And those could be big goals like a house. It could be smaller goals like a car. It could be a life-changing goal like buying your first time home. So all those things could be buying power, but it's having that confidence, it's having that pre-approval and the credit score that's needed to get your goal.
You know
Yep.
what? Oh, I'm sorry. I really never thought about it because I'm a realtor, right? I think of buying power as buying a house, but I never thought about it. You need buying power to get a car.
Yeah,
I mean, in addition to businesses getting a business loan, but I never even
yeah.
thought about that. Yeah,
Well,
people.
and a lot of times the buying power from an individual's perspective, a lot of times those two go hand in hand. There's a lot of times I'm dealing with somebody and we're working on getting their improving their credit score, but we're talking about maybe an expensive auto loan where the auto loan rate is 11 to 12%, and their car payment, by reducing their car payment, frees up debt to have more buying power to buy more house.
Right.
So
Right.
those go hand in hand with real estate. So buying power can be pretty complicated, but it's having that confidence of knowing that every step you're taking is getting you in a position to get closer to your goal.
Yeah, and one thing I was going to bring up is that buying power can mean it's different for everyone.
Sure.
It literally could be someone that went through some challenges in life, had some events in their life, and their credit challenged, and their credit score is, they're suffering from a lower credit score. So for someone like that, buying power could be, I need to get my credit score back up so I can simply qualify for like a first time home buyer, something like that. But then there's also going to be that individual where buying power to them could mean, hey, I'm looking to, my family's growing. I'm looking to get into a larger home. Or
Right.
maybe it's someone like we talked about at auto. Like we have clients that have come to us, especially when Tesla like first came out, and like the waiting list and everything. And, a lot of times we've had clients come in and like, look, I'm looking to get approved for a Tesla. I want to get Tesla financing. So it's like buying power can mean something different to everyone. And that's what's so great about this topic. And we really start kind of diving in what it means. What we're going to discuss here today is applicable once again to everyone, regardless of your starting point. Everyone will benefit by having more buying power, whether you're looking to take it back or you're looking to enhance it.
Yeah, that's a great point.
I love that. Yeah. So, how does somebody increase their buying power?
Yeah, I would
What do
say
you
it
do? What do
starts
you
with
do to
credit.
move that needle besides contacting you guys?
Yeah, it really comes down to credit. This is where we all understand here on our podcast here today, and everyone watching, credit plays a significant role in overall buying power. So usually when we're talking to someone around that, the very first step is we need to take a look at a credit report.
Yeah.
Rick brings this up all the time. I hear him on calls with clients, and it's like, hey, when's the last time you looked at your credit report? Like when someone like first calls in, and that's a very important question because even though there's a lot of like online sites, get your free score here, whether it be a credit card or Credit Karma, but a lot of people don't actually take time to dive into the details and what actually makes up their credit score. So that's really the first step, is understanding, having full awareness of the details within the report. And from there, being able to then make maneuvers, make some tweaks that enhance and improve FICO credit scores and actually strengthen the overall credit profile itself, the credit report. which then opens up more opportunity for overall buying power.
So when you're looking, like you said, people don't know what's on their credit report, right? Or they don't even know how to read it or what they're looking for. So what
Yep.
should they actually be looking for? I know a couple things, like I know longevity of credit,
Inquiries.
big
Yep.
point. Okay, inquiries are a negative, right?
Yep.
Well, they're perceived as a negative for sure. Because let's say Jared had, 10 inquiries in the last year and I had 5. The perception from a risk management perspective and from FICO, it would be Jared is perceived as a higher risk because he's been asking 5 more times for financial resources, right? So it's little tweaks that add up. I mean, we put together a credit builder blueprint, and everybody's plan, their builder blueprint, is unique to what's in their credit report, but more importantly, the steps that they're going to need to take. So the 5 major factors are payment history, right? You borrow $1, you pay it back, you get credit. You fail to make that payment on time, you lose credit, right? The second biggest factor is utilization, where you simply have a limit on a revolving card like a Visa, MasterCard, and how much your balance is each month, right? Length of credit history is important. That's, we're credit life. Everything we're teaching you to do and encouraging you to do and coaching you to do is based upon habits that you want to maintain throughout your credit life, your financial life. And why is that? Because you want to develop these habits so that when you're on vacation, you're not thinking, oh, okay, I can just hope the bank pays my overdraft fee. No, they're not going to. They're going to report a late payment, and then that's going to be on your credit report. Then the other 2 big things are inquiries, as we talked about. Opening up an account is a step sometimes we often recommend. Somebody needs more credit. They need to have more buying power. They need to have more limit, more available credit. So in those situations, you take a step back to take 5, 6, 7 steps forward. So everybody's credit builder blueprint is as unique as their profile. I mean, it literally is a accumulation of that data. So when Jared talks about manipulating the data, that's what we're doing. We're removing data, negative data, and we're replacing it with positive behavior habits to reflect positive data.
Yeah. And I think just to break it down and for someone watching this, like a lot of times I just like to break things down in just really simple terms. Like think about it like this. When you look at your credit report, it's important to understand what's in there and the different types of accounts. So someone may have like an auto loan, they may have a mortgage, they may have multiple credit cards, they may have student loans, things like that. They may have a personal loan. And one thing to think about, anyone that's watching this, whether it be live or a recording, you want to think about, like, you've heard the term like diversify your portfolio, diversify your investments, right? It's the same thing in the credit report. You want to diversify, meaning you want different types of accounts. You want multiple accounts open, because then what that shows is that you're able to manage different types of accounts. And if you're doing it properly, you're going to benefit from that. FICO rewards you for that. So a lot of times with clients, that's like what we're looking at. They may or may not have some negative, history, which would be like a late payment, maybe some collections, things like that. They may not have any of that, but it's really identifying like what's on the credit report now and what can we do moving forward to begin to shape that credit profile in a way that FICO likes, which makes up your credit score, but then also what lenders like. If you think about it like this, it's like when you go to a bank and you apply for something, what is it that you're doing? You want more, right? You're looking to get more. You want more money.
Asking for money.
Exactly. So basically, you want your credit report to show that you have the ability to manage what you have now in a way that's positive, so you appear to be able to manage more. So now the bank feels comfortable to lend you more. So that's a big part of what we do at Credit Life. It's not just credit repair, which is definitely a big tool. That's what we use all the time. If someone has gone through an issue, but it's really helping them understand like the overall concept of what makes up your credit profile, your report, in a way that when the time comes and you're looking to apply for something, you're going in with confidence.
Yeah.
That's
You're
the
not
power.
worried.
That's the power.
That's buying
Yeah.
power to me, is having that confidence.
So, okay, I'm hoping I don't lose my train of thought here. Happens all the time. But what you said about diversification in your credit, I had never thought about that. I work with a lot of first-time home buyers, and I do these live webinars where I work with a lot of buyers, and they might even only have a credit card.
Yep.
So can you give some tips to somebody who might be starting out, who really doesn't have a lot of credit, but they have a goal. Maybe the goal is to buy a house. Maybe the goal is just to get a loan to buy a car or whatever. What are some things that people that are new to credit, maybe some younger people or just people, I mean, there's a lot of immigrants that I work with who come and they have to establish credit.
Yep.
And a lot of people don't know anything about it. So can you speak to that a little bit?
Yeah, I definitely can. So, that's actually really common. We deal with this a lot. There's a lot of times you basically have like two different types of people, and it just view it as like a limited credit profile, whether they be younger or it could be the type of person. This is very common in Minnesota, more of that old school mentality of like, I buy cash, I pay
Right.
cash. And
I
in
don't want
their
to owe
mind,
anybody anything.
I'm
I
off
don't want to
the
owe.
grid.
Exactly. And
I
in
don't
their
want to be in
mind,
the
they're
grid.
no, exactly. And in their mind, they're thinking, well, I buy cash for everything and I can obviously afford things, so my credit's
Right.
probably good. The way you want to look at it is a lender can't effectively perceive risk if you don't have enough data there. So, like, if you don't have enough accounts open, even if your credit score isn't that low, you still could one get denied because they don't have enough history to like base a lending decision off of, or because of that lack of history or lack of accounts, you may end up paying more because they may view it the same as bad credit. Like if they don't have enough, that's what happens. So like if you're someone that's younger, you have a limited credit profile, the first step in what you want to do is take a look at like, well, what do I have? So maybe it is someone that just has a credit card and that's it.
Yeah. Yeah.
Well, in that case, we want to build up one, we definitely want to build up what's called an installment account. So here's a great tip for anyone watching this. You don't necessarily have to go out and get an auto loan or go out and get a personal loan to build installment history. An installment loan is basically like, hey, I'm going to give you X amount of money and at this interest rate, these terms, and you're going to pay me back monthly for this amount of time. You're making installment payments towards that debt till it's paid off in full over time. Well, if we don't have one, well, we need that. We need to build up history. So, like, there's something called Credit Strong out there that's really popular. There's
Okay.
something that was called Self Lender. Now it's just called Self. And we recommend this a lot for people looking just to build credit. And the way it works is it's actually considered what's called a credit builder CD. It's a CD account. But instead of like going in and paying like let's say $1,000 to open up a CD savings account at a bank, what they do is you make payments over time. It could be as low as I believe like $24 a month that you make into an account with Credit Strong or Self up to like let's say $1,000 over the course of a couple years or something like that. You're building up a savings, but what they do is they report it as an installment account, a loan on your credit report. And essentially what you're doing is actually building up savings. There are some slight, fees to it because it costs money to report, but it's a great way to build up savings on the side and get credit as if you're making payments towards an installment loan. And now we didn't necessarily get into debt for no reason. So like now we have an account there, an installment account. And then what you want to do, and I love to do this with people all the time, is definitely take advantage of what's called pre-approvals or soft pulls. So
Yeah.
like Discover is really good for this. Capital One is really good for this. These are two great accounts and credit cards, and you can go to their site. You can literally just Google Discover credit card, Capital One credit card, and there'll always be a link in there that says see if I pre-qualify. And if you click that, you can put in your information. They do what's called a soft pull on your credit, and they see if you're pre-approved for one of their cards. That's a great way to get an idea of like what's available to you without necessarily getting a ding on your credit yet. So
That's
instead of like,
huge.
oh, it's massive because like a lot of times people, if they hear, oh, I need to build credit, I don't know what to do. Well, they may end up getting like, let's say, a secured credit card at their bank, which essentially what you're doing is you're securing the credit limit with your own money. So like $300 deposit, now have a $300 limit card. Well, maybe someone doesn't need that. Discover has great starter cards that are considered unsecured. Capital One as well, and they also have a secured card. So if your credit is lacking to the point that maybe all you can get is a secured card, that see if I'm pre-qualified, that soft pull is so powerful because it gives you an idea. And then for anyone watching this, what you want to do is always choose the first option. So like when you put in your information, it's a soft application, it's going to
Yeah.
come back and say, hey, we see you're pre-approved for these offers. Always choose the first one. That is the strongest one. It's there for a reason. You essentially meet the criteria. You can apply with confidence, and there's a high probability. I can never guarantee it, but it's extremely high probability you're going to get approved. And only then is there that inquiry. But at least you know you got approved, and now you have, let's say, a $300 limit unsecured card or $1,000 limit. And the final thing I'll say, I know I'm talking a lot, but I think this is important for everyone to watch, especially if you're younger. How you manage that card is absolutely critical to your credit scores, but also buying power. So like if you think about it, like when I'm talking at like schools or at the adult learning center or on stage and I'm educating around credit and credit building, there is a massive misconception out there that around credit cards that usually revolve around, hey, only charge, up to 30% of the balance and then pay it off. Or hey, use it every single month, charge it up and pay it off in full. And that shows that I have the ability to use it and I'm paying it off in full every single month, so I'm good. Well, what you have to understand is that when you have that credit card, and let's say it's $1,000 limit and you spent $500 in that month, and then you get your bill in the mail or your email, paper or paperless. The information on that bill is what was already reported to your credit report with the credit bureaus. It's not your payment. So that misconception is, well, if I paid off in full, I'm good to go. Well, the thing is, it's going to report $500 limit. Even if you paid it off in full, it was on that statement. And now you appear to be at a 50% utilization. Even if you paid it off in full, it's not going to reflect that way. Now we actually show higher risk. We look like we're a little bit over leveraged on credit, even if you paid it off in full. So what you want to do is understand, well, what is buying power to me? What do I want to get approved for? Maybe it's a house. Well, if it is, the key is to actually have for mortgage specifically, to maximize FICO credit scores on that credit card, you literally only want to charge anywhere from 1 to 3% of the limit. So if it's $1,000, that's 10 to 30 bucks only. So like Netflix or HBO or something like a subscription, that's it. Get that bill, automatic pay in full, paid off in full. Well, now we're controlling what's on that statement. And now we're showing activity every single month. We're showing positive payment history, and we're showing low utilization. And so now when that person goes to apply for something in the future, they have that Credit Strong account. They have some installment loan history. They had that one previous credit card. Now they have another one. Now we have 3 active accounts, and they're all being managed correctly. You're now building a report that shows that, hey, I'm active. So that's what FICO needs, data. It's just math. Hey, I'm active. You got the data, and it's good data. Now I appear that I can handle more, bank. And they're saying, hey, I see this. I feel comfortable. I'm going to lend you more money. So like that's how you start to build up credit and how you manage it in ways that you can do it that doesn't necessarily get you into a ton of debt at all, but you're playing the game basically. And that's what you want to do. Understand how it works, understand how to play the game. And it also teaches very strong financial disciplines. So when you manage cards that way, you don't run the risk of like spending too much so easy. And all of a sudden you've racked up a ton of credit card debt and you can't get out of it,
That is a misconception because I didn't know that. I thought as long as you paid it off as well, that $500, because I know in general, and let's clarify this, that mortgage lenders, people in general, creditors, are looking at you having less than 30% of your credit card max, right? So you can basically spend up to 30%, and then that looks like a good credit card payment history if you're paying that off every month. So whether it's the $8 for Netflix or you're going out and spending $300 on a dinner, as long as you pay that off. So you want to keep that under that 30%, that spending. Is that correct?
So, and that's what I was just talking about. So that's not necessarily bad. That's still showing positive payment history. It's showing responsible credit management.
Okay.
But if you know that you want, like we brought up mortgage, if you know you have a goal of being approved for a mortgage, what you actually want to do is actually only spend between 1 to 3%.
1 to 3%. That's what you said.
That's the key. That really is. And I know it's so little. It's like people hear that and they're like, what? That's it?
And I'm going to repeat what Jared said that kind of helps my clients when I'm talking and coaching our clients at Credit Life. One of the things that I have to remind them is what Jared just said. It's not the affordability of the dollar you owe. It's, do you have the buying power to take on the next dollar?
Yep.
Right. Okay. So if you're at 30% of that $1,000 limit, that's perceived as higher risk than if you only had a $9 balance on it. Right. The lower the better without it being zero is measurable risk without it being too high. And then it's relative to the goal. If your goal is to
Yeah.
be pre-approved for the mortgage and you want $250,000, you need to be careful, right? You need to be disciplined, and you need to understand that having $100 at risk is more perceived as higher risk than if you owed $9.95 on your Netflix.
Yeah.
And that's how that math comes through. It's not the dollar that you owe. Of course, it's affordable. Of course, 30%, I can handle a 30% balance on my Discover card. Not good enough. If you're wanting to be pre-approved for a mortgage, you want as much buying power as you possibly can get, because that $250 isn't just affordable, it has an interest rate attached to it, right?
Yeah.
So you want to make all that goes together into that buying power. But the most simple way to explain balances is the next dollar you borrow, what's the perceived risk of borrowing the next dollar?
Yeah.
That's a great point.
Lisa, I mean, I know you've helped a ton of clients in your life.
Oh, for sure.
And I'm sure you've had a lot of clients that, they're looking to buy a home, and it's very common, especially nowadays. A lot of people have credit card debt.
Yep.
And if you think about it, I mean, quite honestly, it's very rare that any type of credit card debt has any sort of ROI for that person. It's just debt, and that they're paying interest, right? So the reason why I love this concept of what we're talking about is that it's teaching. I mean, I get fired up about this because we help people all the time that have excessive credit card debt. It's so easy. People use their credit cards like it's extra money, like it's extra income.
I've been to the
That's
Mall of
trap.
America a few times.
Yeah.
I get it.
Yeah.
And so it's like, when I think of buying power, I'm thinking around credit. I'm thinking about credit management, right? But I'm also thinking of like teaching people how to manage credit and their finances responsibly, so they're not spending money like uselessly. It's like, the more understanding someone has, they're like, oh my goodness, I get it now. Because if they just do 1 to 3%, it's very little. They're showing maximum buying power. They're showing the data they have. They're maximizing FICO credit scores. But what it's simultaneously doing is it's teaching them on how to manage cards in a way that's going to also at least help avoid the pitfalls of excessive credit card use, where they're thinking, oh, I just want to buy this, I get paid next week, and then I'll pay it off. And then what happens? Next week comes, the paycheck comes in, they forget they had another bill, and they don't pay it off. They make the minimum payment, and now it's accruing interest, and now it's compounding on itself, and now the balance keeps going up. Before you know it, after a couple of years, they're going, oh my goodness, I have these 3 cards, and I owe 30 grand. Like, what just happened? And my minimum payments are so much, the balances aren't even going down every single month, and I can barely afford this. That's the trap that literally so many people have fallen into. We have the largest amount of overall credit card debt right now. So it's like, there's solution for this. We help people with this all the time. But what I'm talking about is that someone's like younger, just building credit. If you can learn these habits now, you're literally going to put yourself in a position where you can buy the home, and you can get more home because you have a better credit score. And a home is an investment. It's not only an investment, it's a better quality of life for that person. They feel like they have something, they own it, something for their kids, something for their family. So it's like, that is a better use of your money. And credit cards is typically useless unless you maybe invested yourself in like a course for education or something. So like, that's why I like having like open, real conversations with people. It's like, hey, we're going to fix this, but you're going to learn so much that when you're done and you're done with the program, you're armed with so much knowledge now. And it's almost like we've trained you like a personal trainer. Like, hey, you know how to work out now, you know how to eat right now, and I'm setting you free. And that's what we like to do in the credit and financial world.
Well, I am working with one of your clients, and I know she's excited. She was not Jasmine, if you remember, Rick. I think you worked with her.
Yeah, that was your client. Yep.
She's fantastic.
And she is super excited that she is going to be able to buy a house, because I don't think she thought she'd be able to.
Yep.
Well, she didn't. And a lot of the things that Jared and I are talking about today are things that also go against intuition, right? Things that we've learned, talk about education, misconceptions, myths that we've had. In fact, back in the day, maybe a dozen years ago, we had a show on social media called Mythbusters, and it was credit myths. And a lot of what we break down in that consultation, when we're looking at their credit report and talking to them about their goals and the steps they need to take to get to that buying power, are misconceptions. And one of the biggest ones, and I appreciate you bringing it up, Lisa, is the math of it. There's a lot of people, especially my peers, who are very conservative. They don't want to open up any credit. In fact, they've They've heard people tell them, hey, don't open up any more credit. You have enough credit. Why do you want 3 or 4 credit cards? Well, if you understand that the more payments you make on lent money, if you have 4 open and active credit cards, you're getting credit each month for paying off a $9 balance on a credit card. I have, to open up my personal credit, I have a Discover card that pays for my internet services at home, which is like $49.99. I have another card that I use to do like get my hair cut and get a shave. That's usually less than $50. So I have all these things, and these are all things I'm already paying cash for. It's not that I'm going out and spending extra money to build credit. I'm just getting credit for the cash transactions that I'm already taking. I'm just inserting that credit card into that cycle of, okay, my credit card is paying off my Netflix. My debit card is paying off that credit card. My balance is zero by the time the statement hits. And I'm getting credit for a payment made on lent money. And by the way, every 6 months, Capital One offers me another $1,000, $2,000, $3,000 limit increase on my card. That's buying power.
Yep.
That's buying power. That's one of the things I tell people, and I should maybe learn a little bit more, but one of the things that I tell people as a realtor, I talk about the 30%. Now I need to change that a little bit. And now I forgot the other one.
Well, I can give you a little bit of because I was a loan officer, and I can tell you probably where that notion came from. All right. And not to overcomplicate the math, but 30% of your score is based upon utilization.
Oh.
Okay. Now, there's also data modelers out there that when you're working with a loan officer, they can punch in numbers and balances and try to predict what a FICO score might be. All right. It's kind of like AI. It's making an educated guess as to what your score might be, but it's still not your score,
right,
based upon the actual math that's used. Right. So yes, 30% is better than 60%, but it's 1 to 3%. It's not the best. And you want the best when you're going to work with Lisa or anybody.
And Lisa, think about this, because you're in real estate, right? I mean, once again, you've helped a ton of people. You've helped so many different types of clients. But the one thing I bring up, I would say that this is applicable to everyone, but I would say this is typically more applicable to people that are like, whether it be like a first-time home buyer or they're looking to upgrade. And so a lot of times people don't know that your credit score plays a significant role in your mortgage insurance premium. So like
when know that
it's significant. So like if you have someone comes in and it's like, hey, I'm buying a $400,000 home, and let's say I'm at a 640 middle score and I'm getting an FHA loan and I'm putting 3.5% down. Well, your credit score in that specific loan, it's when it comes to like your mortgage, tax, and insurance and all that, that premium itself is largely based off the score. And so if you have a higher score, let's say you go from 640 to like 720, really in around a $400,000 loan, your savings per month on just that mortgage insurance is probably even more than the savings on the interest rate itself. You could go from having to pay, let's say, like $400 a month down to like $200 just by having.
Easy.
And what I tell people as well is that mortgage insurance that you have to pay for isn't even for you.
No, it's for the
That's to protect the lender if you default. So why would you want to pay more? It's not even benefiting you, so like it's all about that. That's another example of buying power, right? Like the higher the score, now you can get more home, pay less for the insurance, and now you're investing in something that's actually benefiting you. Like, so like it opens up like that overall savings, $200 a month in savings, probably based on interest rates today, could be probably easily $20,000 additional dollars in buying power for a purchase price of a home.
Unbelievable.
So like these are like some really cool examples of like how strategic you can get when it comes to credit and like how you can maneuver yourself to get access to more.
Well, this has been very enlightening. I learned a few things myself. We could talk forever about
easily.
but
we make it fun, right, Lisa?
Absolutely. It's very interesting. I learned some things. I hope our audience learned some things. We are out of time at this moment. We're almost at 30 minutes. We normally run around 20. So I want to thank you both for being on.
Well, thank you, Lisa.
I want to thank our viewers for watching. If you ever have any questions, throw them in the chat. We're going to have Rick and Jared's information in the comment section. So if you want to get in touch with them, they would be happy to answer any questions or help you with your credit and get you some more buying power. So have a great day, everyone.
Yeah, everybody,
again.
enjoy.
See you again.